Hi, and welcome back to the Business Career College video series. In this video, we're going to have a look at the Pension Adjustment Reversal, or PAR. Now, the Pension Adjustment Reversal did get a brief mention in another video concerning the calculation of defined benefits, but we're going to work through it a little bit more here. So the PAR is not terribly common. It's not something you'd run into on a day in and day out basis, but it can have some financial planning implications. So the PAR is based on a defined benefit pension. And what we know with a defined benefit pension is that the employer must fund at least 50% of the cost of that pension. Now, this 50% test is only done at plan termination. So normally that would happen when the employee leaves the plan. And we're most concerned here generally when an employee leaves after they're vested. So whenever vesting happens, in many provinces now, we're moving to immediate vesting, where we have vesting without any waiting period at all to vest. Some jurisdictions are still using a 2-year vesting period. So where does this come from? Well, you're most likely to see this with an employee who is younger, somewhere south of age 35 maybe, and it's going to depend on the level of contributions. So let's say that we have a defined benefit pension plan, and we have a plan member who is age 25, so relatively young here. And this plan member, let's say, earns, how about $60,000 this year in 2015. And the plan has the following provisions in it. The plan promises a benefit of 1.4% as its defined benefit on income up to YMPE, and let's say 2% as a benefit on income over YMPE. And in exchange for that, the employee's cost for joining this plan, let's say, is 9% of their income up to YMPE, and let's say 11% of their income over YMPE in exchange for that higher benefit. And you may want to go back and review how YMPE impacts on our defined benefit pension here. The important thing is that this means we have two different levels of benefits accruing, one based on that YMPE, which in 2015, YMPE is $53,500. So basically, related to this 1 year of service, if we just carve out this 1 year of service, then we can see for this year, just based on this 1 year of service, that this employee will have accrued a benefit of $53,500 times 1.4%, plus the remaining amount up to $60,000, so another $6,500 at 2%. This employee will have accrued a benefit of $749 on income up to YMPE, and then $130 on income over YMPE. This employee knows that for this year of service, in retirement, they will have a benefit of $879. Basically, if we can carve this thing out, this employee knows that assuming a normal retirement age at 65, that from age 65 up until mortality, this employee knows that there will be a benefit available of $879 a year. So now the employer says, okay, what do we have to put in place in order to fund this? And this is where we do a little bit of a time value of money calculation. Basically, we can present value this back to age 65, and then we can take that present value, use that as our future value, and get a present value at age 25. And this is going to require an actuarial calculation, but we can estimate it. We can do a quick bit of time value of money. I'm not going to work through it on the call, or sorry, on the recording here, but I'll show you that the time value of money here of this is going to be roughly, this will be roughly $7,700. So the employer knows they have to have $7,700 set aside in order to fund this eventual benefit, and this is something that the employer's not going to wait to build up. They have to have it put aside this year, because next year the employee is going to work again. There will be an additional commitment for that, and so forth. And every 3 years the pension is going to get tested for its solvency, and it's going to have to show that it has all of these $7,700 that it needs. So how much did this employee put into the plan? We said we've got a 9% contribution rate up to YMPE, and then over YMPE we've got that 11% contribution rate. So this employee will have provided on their income up to $53,500, $4,815. And on their income over that $53,500 level, another $715, this employee has contributed $5,530 towards this obligation of $7,700, which is far in excess of that 50% limit. So what has to happen here, remember, the employer has to have funded at least 50% of this. So the employer must have funded, we can take that $7,700 times 50%, and we can see that that's going to be $3,850. When they clearly haven't. They've only funded, because the employee put in $5,530, the employer at this point has only funded $2,170. So another way of looking at this is the employee has put in more than their obligation. So we can say, hang on here a second, employee, you put in $5,530. You should have only put in $3,850. Now, it's important to recognize that this is only going to be tested at the plan's termination when the employee leaves. If the employee works here over the course of 40 years, when we get to later ages, you're not going to have a pension adjustment reversal calculation, or you're not going to have to worry about the 50% test, because an older employee is substantially more expensive for each year of service. So this employee is going to get $1,680 back out of this plan because of this overfunding. And this will be paid to make up for that amount over the 50% rule. Now, the problem here is that this is going to be taxable. And the other issue is that this employee will have lost most of their pension room this year. They will have had a pension adjustment for this year based on $879. That's that benefit entitlement we saw up here, times 9 minus $600. This employee then has a pension adjustment of $7,311. And they have then lost much of their RRSP room as a result of this. So what has to happen now is we're going to restore some of this RRSP room. Basically, we don't want to penalize this employee by forcing them to take this as taxable income. So what we're going to do at the same time here is we're going to undo or reverse this pension adjustment. We're going to have this pension adjustment reversal, and it's going to be roughly $1,680. It's a little bit more complicated than what I've shown here, but this will be very close. And the idea here is to allow the employee now to roll that into an RRSP, or to transfer that to an RRSP, and then they could have it continue to be tax deferred. In essence, now they're not taking it as income, they're just transferring it right into the RRSP, continuing their tax deferral. It's essentially the same as if they had taken it as income and then transferred it into the RRSP, except for the timing of the taxes, because here you're not going to have to pay any tax at source, whereas if you took it as income and then transferred it as an RRSP, you'd have to wait to get your tax savings. Here you're going to get your tax savings immediately, which is always beneficial. So I hope this helps to understand the pension adjustment reversal. It's a little bit more obscure topic with respect to defined benefit pensions. It's something that's often not well understood, but we can see that there is some benefit here to actually seeing what's going on. It helps our younger clients, especially who may be leaving defined benefit pensions, to understand the full tax consequences associated with that departure. I hope that this does help, and I hope you enjoy your continued studies. Thank you very kindly.